How private equity raises funds. Have you ever wondered how private equity raises funds? Investor partnerships for private equity are a task that demands a step-by-step guide. Private equity raises funds in a simple 8-step process. The processes could be split into 3 different stages: the pre-offering, offering, and closing. Here is how private equity raises funds. We must appreciate the fact that private equity firms are also a company. The private equity firm also wants to grow and become a big company. Private equity raises and manages funds. They have a pool of investors who contribute to their money. Once they have enough money, they buy a business and manage it before selling it back after the fixed period. The investors are family trusts, high net worth individuals, pension funds, and other organizations. These combined investors put their monies in many companies and look for a return on it. The fixed return on this investment is generally within 3 to 10 years. The returns on these investments are better than public stock investments. This means that a company going into a private equity partnership is going into a cycle for 3 to 10 years before being sold. The company is going to receive mentorship from your team of experts. So now that we have a perception of private equity partnership, we can discuss how private equity raises funds. So imagine you wanted to start a private equity firm. What would you need to do to raise funds? Pre-offering. 1. Define funding strategies. The easiest way to secure investment for your organization is for you to be prepared for it. Once you have a clear and precise strategy, you are more likely to get the investment you want. The planning process makes it less challenging to implement the strategy for the partnership. Whatever the terms and conditions that you consider favorable to your investment should be determined here. This first step is a planning stage before you approach investors. This will give you enough time to ask for what you truly deserve. Whatever deal you want, you must strategize at this stage. It should not happen that you approach investors while not knowing precisely what you want from them. So the primary basis of your contract must be decided in this first point. It is essential to know the strengths of your company. Are you one that will only provide cash to companies and then allow them to work with it? Or will your firm be heavily involved in management? Do you have the quality of mentorship and expertise in the different fields you want to invest in? It would be best if you had all these answers prepared as the first step to raising funds. 2. Business detail. The second step to generating funding for your private equity is by preparing a document of the business detail. The right team to manage the funds will know all about numbers. You cannot set out to have investors on your team when you do not have your business details. Like private equity, you will request meetings with the most influential people in the financial world. You will be interacting with estate managers, university endowment fund managers, private business people, pension trust managers, and more. Your business activities must be detailed on paper. You cannot walk about with the plan in your head and not adequately put it out in a financial model. The strategies, the budgets, and known market numbers should be at your fingertips for the process. Private equity raises funds by research and documentation of projections. A business detail for your investors is a step in the right direction. This will make your presentation to any investor as professional and straightforward as possible. 3. Find investors. The least difficult part about finding investment is identifying investors. Many of them have made their interest in private equity known all over. They wait for your initiation of interest in them and your proposal. The investors should be within your area and field. You can research the current companies and their public investors. The other place to search for investors is your network. The contacts and connections from within are often the easiest to speak to, and they do not make you feel stressed with their long meetings. It is also proper to try speaking to business schools. It may surprise you to find out that many investors sign up at the schools for such opportunities if you are overwhelmed with the process. However, it may be prudent to appoint a financial advisor to your team to assist with the process of finding investors. But between your contacts, a business school, and online searches, you should not struggle to find investors. 4. Create a presentation. The presentation should be created to impress. The best way to make your presentation stand out is to incorporate insights from other people. When you know the presentation made for the business details, you should run it by people who mentor you in finance. You can run it by your friends in the professional circle to know the reactions. That way, you gather enough feedback to work on it more till it becomes the best. The investors will like to hear a story. They want a presentation that stands out from the others. This is because many people move to these organizations daily with a presentation, so standing out is critical. As the ultimate presentation comes up, you will be in the lead of securing all the funds you need to start your private equity endeavors. As you arrive at this step, you have completed the first stage of the fundraising process. The pre-offering stage has been completed. The next step is the offering process. Offering. The offering process is where the firm first interacts with the investors. This stage is key to securing funding. So all the pre-offering preparations will come to life in this stage. 5. Organize meetings. There is a roadshow of meetings that come with funding from investors. The private equity funding process is what is considered a numbers game. There is no certainty that anyone will come on board because they gave you a meeting. You have to set up many meetings if you are going to secure something. Think of the situation where you book a single interview, which does not end well. One becomes of the process. It would be best if you approached as many investors as your search produced. You will then facilitate meetings so that they work in your favor. Think of the meeting as an event that you are planning. Everything has to be perfect. The venue, time, audio-visual equipment for your presentations, and story delivery should be impeccable. Once you manage to pull off the meeting in this fashion, nothing will stop you from getting the funding you deserve. You will impress investors by being fully prepared before you get into the details of your business proposal. Once again, here's where you must have all the business details at your fingertips. You will need them for the questions that will follow your presentation. 6. Facilitate post-presentation. When you manage to get the presentations done, you have to follow up. The pitch going well is one step closer to the goal, but not the result. You will need to include due diligence in your follow-up. The investors will rely on your zeal to provide them with supporting documents and follow-up meetings to determine your seriousness. The investors will be looking for someone who is constantly on their toes, trying to get some feedback. That is a strong indication that whatever they invest in your fund management, you will be able to stay on top of it and ensure that they get their returns in time. All due diligence must be made once the meeting ends and documents are provided for further deliberations. The remaining email exchange, meetings over coffee, and more documents will help facilitate the process for you. Sometimes some numbers need to balance correctly, and those that need to go. All those edits must prove your attention to detail and due diligence. Closing. The closing is as important as the start. You cannot afford to make mistakes now. This stage will require a lot more than due diligence. You will have to involve legal notaries and attorneys, but ultimately, you are getting the funds. 7. Negotiations. The negotiation stage is also vital for the process. It would help if you had advice from an attorney to help you ensure that you are not doing anything that would put you in the wrong place later. Your negotiation should ensure that your team of investors gets the best of their investment. It would be best if you also benefit from managing the funds. The investors will ask for percentage cuts and more returns, so you have to be convincing in your negotiations. 8. Sign. The final step after everything is considered for you is to sign the agreements. These investors are coming to you as a firm to do business. You have to sign and then go up to celebrate with your team on the excellent work. Once you sign the contract, the real work begins, and you become a fund manager, so take some time off to celebrate your hard work. Private equity raises funds by contacting organizations that handle significant monies. Getting these organizations to put money in a fund takes 3 stages and 8 steps, as we have mentioned. Which of these steps do you find the most cumbersome, and which is the easiest? Let us know in the comments if you will be able to raise funds through these steps that we have run through.